Explain exactly why this might drive people toward private equity.
Yeah, so the idea was to look at, just assume this 6% is going to be a barrier. If you're not making more than 6%, your wealth is going to go down. So let's look at some capital market assumptions that are out there. We looked at GMO, we looked at BlackRock, JP Morgan, all the ones that are publicly available. And if you look at those, take it at 7 years, 10 years, there's sort of one game in town, and that's private equity if you want to surpass a 6% tax.
But won't they essentially evaluate whatever the value is of the private equity, impose the wealth tax on that valuation?
Sure, but the goal is beating that 6%, right? So, I mean, that's the option if you go by these capital market assumptions.
But under that analysis, the government would still get the money. She'd still have the money to pay for Medicare for all, so it doesn't come out of that. It's not really tax avoidance.
It's not tax avoidance. It's the idea of just where do you have to put your money, where do you have to reallocate some of your money to beat that 6%.
It's sort of a different form of a search for yield.
Exactly.
You need higher yield if they're going to take some of your wealth away.
Exactly, and that's why we sort of draw a comparison to looking at what endowments and pensions have been doing in a low interest rate environment in consideration of their own hurdle rates.
Brandon, does it suggest other sort of alternative investments? It's not just private equity, but things like real estate and other things that are somewhat riskier but particularly higher reward.
Certainly, and it depends on which capital market assumptions you're looking at. Some of them show other options, hedge funds, mezzanine real estate debt, things like that are also there. But private equity is the one that seems to be across the board that shows up above that 6% threshold.
Very interesting piece.